Okay, folks, here we are with the Zoopla UK House Price Index report for June 2023. This is an oversight from Zoopla themselves. Good evening to the Instagram viewers. This is an oversight by Zoopla themselves to an assessment of where the whole housing market is. They'll probably be looking at the first half of the year as well and taking these statistics into account. And it gives us a good indication about where the market is right now in comparison to where it was before, but where it's actually going to be as well. I'm going to give some insights into where I think the market's going, and also where I think base rates are going, where I think inflation's going, and how that can affect house prices, but also how can it affect whether a buyer or seller's market, and whether it's going to affect the ongoing UK economy potentially. We'll maybe cover these sort of things. Sometimes I like to digress and like to go somewhere else with this. But their executive summary for Zoopla, they're actually saying that the executive summary is house price inflation slows to 1.2% as quarterly growth rate turns positive, following a pickup in sales activity over the spring period. Now, this is according to Zoopla's numbers, remember. This is not land registry numbers, which is the overall housing market in the UK. This is Zoopla's UK House Price Index and how they see it, according to the number of people that are actually selling through their website and also listing through their website and inquiring through their website as well. And this is their sort of supply and demand. And we'll see how that differs in terms of what I'm getting from other sources. For example, the actual Office of National Statistics UK house prices overall in comparison. They also go on to say as quarterly price falls set to return in the second half of the year as higher mortgage rates hit buying power by up to 20%. Wow. So they're in the second half of the year, which is what we're in now from July to December, higher mortgage rates are going to hit buying power by up to 20%. It's quite a high number. Jump in proportion of sellers having to accept discounts to asking price of more than 5% in recent weeks, according to them, rises to 42%, returning to their 2018 levels. Now, what they mean by that, what Zoopla means by that in terms of the 5% discount, it's the discount on their asking prices on Zoopla's website. And that takes the whole of the UK. Now, generally, the English market tends to work on a discounted rate because there's no home reports, so it's not based on the previous house sales. So in terms of the Scottish market, we're determining our prices based on historical information, whereas the English market determines their prices on what they think they could actually achieve. So their pricing is almost in the stars, and they'll catch the moon on the way down. Whereas our pricing is almost on Earth, and we're trying to push to the trajectory of the stars and hit the moon on the way down. So we're opposite ends of the spectrum from the English market in terms of how they work, in terms of how we work in Scotland, because we have home reports and they don't. So their prices are set by estate agents, where our prices are set by really chartered surveyors in terms of the home report standards. Okay. So they reckon, according to Zoopla, UK house prices are still on track to fall by up to 5% over 2023. And further downside risk is if they see an acceleration of supply of homes for sale that boosts choice and further room for negotiation with estate agents overall. Yeah, well, there's no surprise there. But we're still not at levels in Fife, for example, of just let me check the Fife market. I'm going to go into Zoopla's website and we'll quickly look at that. Just a quick look for myself, and I'll quickly type in Fife. Apologies, I've got something set up already, so it's no easy for me just to switch over to the website and show you Zoopla's, but I just want to check how many properties are on the market. Yeah, 854. Well, there's no time soon where the Fife property market is actually going to slow down or is actually going to change from supply, because 854 is way below pre-pandemic levels for the number of properties on the Fife market of over 1,200 properties. So Fife, in terms of supply, is still quite restricted in the sales market. What is slowing the Fife market down is exactly what Zoopla is saying here, and it's actually the mortgage availability. In other words, how much people can actually borrow up to is the slowdown factor. So the up to the Mid-market, which is around about the 250,000 mark, there is really good buoyancy because it's still affordable for most people in Fife, especially for people upgrading. The mortgage availability and the affordability is still there. But when you go from 250 upwards in terms of the Fife market, it tends to be that there's a lot more to pay on a mortgage. Therefore, a lot more people can't afford it as could have afforded it before. We can see that now because I'm going to visit people and they're saying their mortgages are coming up for renewal in September, August, October, November. And they're now saying they're going to have to take a decision probably to put their house in the market now, rather than actually wait for D-Day and then realise it's like we're cutting it fine in terms of our budget now. And there's almost like a too much month at the end of the money, if that makes sense. So that's why some people are actually taking a decision to put their house in the market now in prelude for the fact that they're going to come out their existing fixed rate deal to a new one. Now, newsflash, if you don't know by now, you can negotiate with your bank, by the way. I don't think anybody's really aware of that, and it's not widely known. But technically, if you're going to be coming out of your fixed rate mortgage, you can potentially negotiate with your bank to get better rates than what's actually advertised right now, even to get possibly a holiday in your mortgage payments, or even possibly to pay interest only as well. Now, that's not widely known, but some banks are very sympathetic towards that, especially if they've got that same policy that they had in the credit crunch. Now, this is no credit crunch. This is not going to be a problem about credit because there is an abundance of money and supply in the system. So it's not going to be a credit problem, and banks aren't going to withdraw funding as easily as they did in the 2008 scenario. So it's still going to be available for finance. What they're going to do is they're probably going to be more creative in pushing their mortgages out a lot longer in the term to bring the monthly payment down. So a 25-year mortgage is now going to be a 35-year mortgage, and the monthly payment will come down by possibly about 20%. And that will be more affordable to a lot more people by pushing out a 35-year mortgage. Again, that's another way you can negotiate with your bank to bring your cash flow down on a monthly basis to a better term. But speak to a mortgage advisor about this. Speak to your existing bank about this as well, because potentially they could possibly help. Once you're into another deal, that's a no-go. So you're better actually to negotiate as you're coming out of your deal, or you're coming towards the end of your deal that you've got right now, in order to go into that variable rate. And that's when they'll go, they're no daft, they want to keep you as a customer. That's when they'll want to negotiate with you. They'll maybe give you a wee bit of resistance in the first place, but explore these opportunities of maybe having mortgage holidays for 6-month periods, maybe possibly having a longer term on your next mortgage, and actually see how that works out for you on a monthly basis. After all, if you can negotiate a better deal which keeps you in a lot longer in your house and you've got certainty in your monthly payments, then that's probably better than actually moving, because moving and selling and buying is going to cost you a lot more in terms of entry and exit for the cost. So the cost of selling and the cost of then buying again is going to be a lot more than possibly negotiating with your bank right now. That could be something up to about £8,000. And yet, over the next 5 years, the additional amount you're going to pay every single year over and above your normal mortgage now and getting another mortgage is probably going to be a lot less than that overall. So that's maybe something that you could speak to your bank about. So let's go back to the UK house price index though. So that's an overall overview of the UK market. So the letting house prices are still on track to fall by 5% according to Zoopla. Further downside, the risk of the acceleration in the supply of homes coming on. We don't see that in the Fife market just now. Anyone serious about selling in 2023 needs to be realistic on pricing. That is a key strategy here. Anyone that's thinking about selling and serious about selling in 2023 needs to be realistic on the pricing. A drawn-out realignment of house prices and household incomes are ahead, according to Zoopla. I kind of think that as well. And that's what I talked about in terms of your monthly cash flow going out, and actually being able to renegotiate that with your bank so it comes down, but your mortgage term goes a bit higher. You will pay more overall on your mortgage. But potentially, maybe in the next 5 years, mortgage rates will come down significantly. Maybe in the next couple of years, mortgage rates will come down significantly. And you could go back on a better deal and bring your mortgage term back in again to the 25-year period and pay it off quicker. So these are all things you've got to think about in terms of where you are right now with your mortgage. Speak to a proper qualified mortgage broker though. If you need me to put in touch with someone, then please feel free to message us, because we'll put you in touch with some of the best mortgage brokers available who have really good deals. Now, that can apply to a buy-to-let mortgage as well as a normal residential mortgage, which you're staying in just now. So let's see some key graphs here. Just overall, let's see where we are at 1.2% annual price inflation, 42% accepting discounts of more than 5%. They see that, and minus 11% hit to buying power for mortgage rates rising from 4 to the base rate of 5%. And it's actually a wee bit higher as well. And it probably will go a wee bit higher as well. Okay, so let's look at a graph here. Now, this is the average sales and supply by, but fewer buyers in the market. Now, here's the comparison here. Above average sales and fewer supply. So the demand is down by 14%. Now, this is in comparison. This is the percentage change 4 weeks to the 18th of June compared to the 5-year average. So this is compared to the 5-year average. So the 4 weeks to the 18th of June. So that's the period of the June period that they're saying there, the 4 weeks, the month. It's 14% down on the 5-year average in terms of demand. So there's no surprise that demand's a lot less than what it is because base rates are rising. The number of sales agreed, though, surprisingly, compared to the average year demand, is up by 8%. So there's more houses getting agreed sales than there was in the average 5-year period just past. The flow of new supply is 18% more than the 5-year average. So again, there's more properties coming on the market. Not necessarily in the Fife area. There's a lot less than what there was pre-pandemic. You need to check your individual area, but we will talk about that. And the stock of homes for sale is up by 11% as well. So that's one still sitting on the market right now. So what is Zoopla going to say? More testing times as mortgage rates rise beyond 5%. Okay, after a better than expected start to 2023, and affordability dynamics of the new home buyers have deteriorated over the recent weeks. Stubbornly high inflation has sparked financial markets, has spooked financial markets, with expectations that UK interest rates peak at possibly 6%. So they now factor in the possibility of interest rates and base rates peaking at 6%. Mortgage rates have increased by over 1%, now averaging between 5 and 6% compared to a less than 4.5% in the spring period. On Zoopla's view, they actually remain that 5% mortgage rates represent a tipping point beyond which house prices will post annual price falls below the average sales volumes. The report explores the very latest trends and concludes that we're still on track to price falls by up to 5% in 2023. Now, whether that's going to transpire in the Fife market, particularly, Fife market is still quite buoyant, according to the average national statistics on the house prices index. Fife is still sitting at 3.2%, more than in the previous 12 months for house price, but yet it's a lot higher than what the Scottish house price is, but just slightly lower than what the UK house price is. But this, remember, is Zoopla's numbers. They go on to say sales momentum's recovered over the first half of 2023. And then they say mortgage rates falling towards 4% over the early months of 2023 supported a recovery in the demand for sales, and that's why you've got a bit more buoyancy in the market. UK consumer confidence has also rebounded over the last 5 months. So this is how they saw the first half of the year. In the last 5 months, as the labour market remains strong, earnings rise, and energy prices are starting to fall. So they're starting to fall as from the 1st of July. It puts a lot less pressure, and that money from the fall in energy prices can then be reallocated to other budgets in the household, namely, possibly mortgage interest rates and mortgage payments. They go on, Zoopla then go on to say total new sales agreed in the first 5 months of the year recovered within 2% of the 5-year average, which is actually quite encouraging. This improvement in the sales volumes has led to a small increase in the 3-month rate of the house price growth, reversing the quarterly price falls recorded in the quarter of 2022, the last quarter of 2022, and the first quarter of 2023. Other indices have actually shown a similar pattern recently, indicating that sub 5% mortgages are consistent with a plus or minus 2% house price inflation. Sales agreed over the last 4 weeks are 8% above the average for the 5 years as households with cheaper finance locked in look to secure homes as mortgage rates for new business spike higher, but are wide regional variations in underlying market conditions overall. In the last 2 weeks, there have been some early signs of a decline in the demand, dropping below 2019 levels, which is likely to increase over the summer. So let's have a wee look at this. So this is the rebound in sales growth. So as we can see here, apologies to people on Instagram, you can't show charts on Instagram. You can only show them on Facebook and LinkedIn and Twitter and various other channels. But unfortunately, if you're doing lives on Instagram, you can't do that. So if you need anything on Instagram, please pop over to Five Properties TV on YouTube and you'll actually see this live right now. Okay, so this is a graph in rebound in sales, slowest pace of quarterly price falls. So this is actually from December 2006, 2007, 2008, right up to 2023. And this shows you the quarter on quarter and then year on year. So this is the rebound in sales, so quarter on quarter. So you can see it dropping in. There's no surprise in 2008 where it dropped like a stone because that was the credit crunch overall year on year. And then it started to peak up and then it started to drop again 2011. And then it started to be quite stable, I would say. A wee flurry in 2013, 14, dropping again 2018, 19 and 20 because we went into pandemic. And then the boom came in and house prices started to rise exponentially again. And then they've come back. So they reckon the projection to the end of the year is roughly round about the 4% level, under in terms of minus house prices. Now, I still think we're round about possibly by the end of the year, we'll see a minus 5% price drop. Now, what does that mean? Well, in the last 3 years, house prices have gone up 30% in value. So if we see a drop of 5% by the end of the year, literally we're only back to midpoint of 2022. That's effectively it. So if you bought your house from before midpoint of 2022, the minus 5% is neither here nor there because the price is back where it was before when you bought your house. So you're not in negative equity. It's only people that have bought in that last year that would have that 5% drop. But the reality is, the majority of people that buy in the last year will not be selling their house anyway. It'll almost be impossible. They will not be selling their house at all. It's very, very rare if anybody moves into a house and then moves within 1 year. Typically, people will rent otherwise because the entry and exit costs are so high. So the 5% drop by the end of the year won't make any difference. The most important thing we've got to think about in this market, for the health of the housing market, the most important thing is not the price drop or the prices themselves. It's the number of transactions every single month overall the whole of the UK, because that is the true health and the true pulse of the market. Because if the number of transactions, I've got my hand on my pulse, by the way, my fingers on my pulse. If the number of transactions are the same every single month, it's like your heartbeat, and that's like the lifeblood. It's going through the housing market itself, and that heartbeat keeps going. And if it's consistent every single month, that means the health of the housing market is going to be consistent as well, because the jobs that are created because of that, and the contractor's business, and everything that goes in, fitting kitchens and bathrooms and that, will all be the same, and people will still remain to be employed, and they'll still have business to operate on. Therefore, jobs will still be sustained. Therefore, unemployment will still be at the same level. Therefore, revenue will still come into the exchequer in terms of what they're expecting. Therefore, the economy will run perfectly, in a sense. It's when the number of transactions every single month in the housing market is a lot less. That's when we've got to be concerned, because then the natural flow of the life cycle of the housing market overall it's like the heartbeat begins to drop. Therefore, the body of the housing market starts to die. Therefore, the banks start to get worried. Therefore, the risk goes up. Therefore, the mortgage rates have to go up potentially. And therefore, they have to become more creative, or they have to then start withdrawing products, or then have to start making sure they are covered in terms of liquidity overall. That's the key. So it's not necessarily house prices that are the most important thing. The most important thing is affordability, but it is also the number of transactions every single month is the true health and measure of the housing market. Okay, so let's go on to talk about annual house price growth. So they talk about annual house price growth. This is Zoopla, to move negative in the second half of the year, which is July onwards to December. While quarterly, they go on to say, while quarterly price falls have slowed, the annual rate of UK price growth continues to slow rapidly, and now stands at plus 1.2%. That's still a plus. There was predictions of massive crashes by this point in time. That's not materialised. There was a prediction of a recession by this point in time. That's not materialised either. So we're still on a good track. On a regional basis, Zoopla are going to say house price growth ranges from 2.5% plus in Wales to 0.08% in Ireland, Northern Ireland, and average prices in London are just minus 0.2% lower, while in other areas are registering a very low positive price growth. And that is good. We don't want huge price growth in the housing market, really. It has grown to realign with, salaries and wages and all the rest of it, and the way the economy is working with interest rates at a record low. But now interest rates are going up. It will sort of realign to come back to that sort of price point where the measure of the house price and the mortgage availability and the mortgage affordability is probably similar in terms of percentage terms of a salary as it was 2 or 3 years ago. So they go on to say the momentum in sales, this is Zoopla, over the first half is not going to be maintained into the half of this second half of the year. No surprise. Tell me something I didn't know. Higher mortgage rates will hit buying power and squeeze more buyers out of the market, bringing a return to small quarterly price declines in the second half of the year. UK house prices remain on track to fall by up to 5% over 2023, according to Zoopla, as I said. Buyers' market continues in the second half of the year. So they're seeing a buyer's market now. Their data, Zoopla's data, actually shows 14% fewer buyers in the market over the last 4 weeks than the average over the last 5 years. However, those that remain appear committed to moving home. Remember, people move home for their circumstances. They don't move home to make money. That's very rare that ever actually happens. Your home ownership secures your place on the housing ladder through the volatility of prices going up. Because if you've got a home and prices go up, your home goes up and the next home goes up as well. So you're not really making any money. You're just trading one for the other, but keeping yourself what we call hedged against inflationary pressure in the housing market by having a home and owning a home. So they go on to say there is evidenced by sales agreed running 8% above the average. So, sales are pretty good above the 5-year average, although a wide regional variations in underlying supply and demand balance, typically, as I spoke about, 5 there than now. Number of new sales being agreed continues to run above the national average, especially in Scotland and the Northeast, where housing is more affordable. I've always said that. Housing in Scotland is 6 times the average salary. A buoyant housing market is 6 times the average salary. Housing in Fife is 5.5 times the average salary. Buoyant market is 6 times the average salary. It's the affordability for the mortgages on higher value properties, which is the issue here. So the higher end of the market is going to there might be a breakaway and have a 2-tier system where we've got the midpoint and the lower end of the market, which is doing very well. Higher end of the market might take a lot longer and be a bit slower to move. And people at the higher end of the market need to be probably more realistic with their price point and what they really want to achieve. But more importantly, what they want to why they want to move. What's the most important thing? Is it actually getting the most money possible, or is it actually getting on to the next step? So your journey. And that's a trade-off. That's a balance. Sometimes some people have to come to a realistic conclusion that that's what they need to do in order to move on. So sales volumes remain low at or below average in most English regions, but that's because the price points are a lot higher, where house prices registered some of the greatest gains over the pandemic years. This has made homes less affordable in the English areas, exposing sales volumes to the impact of higher mortgage rates on buying power. Zoopla's localized house price indices shows a clear link between price growth and the level of actual price houses. Its markets and average prices over 350,000, where further price falls are most likely. See, there you go, top end. The east of England and the southwest, the East Midlands and the southeast are areas where it appears house prices will need to adjust the most. Let me just show you what we're talking about here. Here we go, right here. So here's the graph right here. Increase in sales with larger discounts to asking price. So this is over 5% discount. This is over 10% discount. And you can see that the increase in sales to the 10% discount and the 5% discount overall. You can see that by the two graphs here. So what does this tell us? This goes on to tell us 2 in 5 sellers having to accept greater than 5% off their asking price. Zoopla goes on to say today's buyers are driving a harder bargain on agreed pricing. Sellers are having to accept lower offers than on the average are 3.8% below the original asking price, according to Zoopla's business data home track. So they monitor all these things through the home track area. Now, remember, this is right across the UK. So this isn't exclusively to the Fife area, but the Fife area is actually holding up extremely well in comparison to the UK itself. And also you've seen right across Scotland is holding up quite well in comparison to the UK overall. Zoopla has also seen a jump in the proportion of sellers accepting bigger discounts on asking prices recently. More than 2/5 of sellers, that's 42%, are having to accept offers that are more than 5% below the asking price, the highest level since 2018, when annual UK house prices growth was just 1% at that time. Over 1 in 6 sellers are accepting discounts greater than 10% below the asking price. 1 in 6, on a level that remains more stable overall. So where does it leave us then? Well, let's pop on to the next graph and say the higher rates. Here we go. This is the higher rates hitting buying power by up to 20%. So you can see there the size of the actual affordable mortgage up to the 200,000 price point. And you can see 195,000 there, and the higher rates hitting the buying power. And you can see as we go into the 174, how much mortgage can be offered with the same monthly repayment on the monthly rates rise. So in other words, if the rates rise from 4% to 5% to 6%, you can see how 195,000 mortgage on the same income level, when it goes to 5%, drops by 11% in affordability, and then drops by 19% when it goes to 6% overall in the mortgages. So the higher rates are hitting buying power by up to that 20% number there. So as it goes up to 6%, the buying power drops by 20% on average. So Zoopla goes on to say then, higher mortgage rates deliver a 10 to 20% buying power hit. Right, okay, so looking ahead, mortgage rates look set to remain above 5% over the coming months, delivering a further hit to the buying power of mortgage-reliant movers who account for 7 in 10 property purchases. If the money market expectations change, then mortgage rates could start falling. So it's the money market is driving this. Remember, it's the swap rates between the bank that influence us. The Liz Truss budget caused a catastrophic problem with the swap rates. They all became higher, therefore mortgages were higher. Once that was all sorted out and Liz Truss was booted, and so was our Chancellor, and it was all stabilised, the swap rates dropped completely, and that's why mortgage rates start to be more affordable as well. Now we're coming into higher base rates because the Bank of England's pushing that up to curb inflation overall as their one club approach. You can see my eyes rolling there, as if that's the only way to curb inflation. There's other ways to curb inflation, which they should be doing, but they're not. They're just using this one club approach and basically clubbing, mortgage holders and homeowners that have got mortgages. That's all they're doing. That's how they see this battle. Let's just go for the people that have got the mortgages. Thanks for that. Remember that next time round you come to election, by the way, and vote with your feet. I have, so 1 in 7 10 purchases with the money market expectations, mortgage could start falling. Zoopla have updated their analysis on the extent to which higher mortgage rates reduce household buying power for an average purchaser with a 75% loan-to-value mortgage. Mortgage rates moving from 4 to 5 is the 11% reduction, as I said, in the buying power. And the gap rises to 20% of the mortgage rates rise from 4 to 6%. This will not feed directly into house prices. The hit to buying power from borrowing costs rising from 2 to 4% has slowed the rate of price growth rather than driving sizable year-on-year price falls overall. Lower sales volumes have also masked the impact to some degree. And that's basically because it was a lot higher in terms of the buoyancy of the market. Therefore, that demand and the number of buyers has actually come down significantly since more than the 5-year average. And now we're beginning to stabilize. So I think personally, the word stabilization is probably the most appropriate comment here. Buyers can offset reduced buying power by either injecting more equity into purchases or taking longer mortgage terms. What did I say in the beginning? Taking longer mortgage terms. Move it from a 25-year, a 35-year, and your monthly payment drops by 20%. You'll pay more overall, but on a short-term basis, it might work for most people without having to move. And personally, that's what I did in the very beginning when I first started about 30 years ago. I did these sort of things. This is the stuff that I did because I knew I would probably get a better position because I was training to be an accountant at the time. I knew my salary would go up. So in the short term, it was all about conserving cash on a monthly basis and making it more affordable for me to still continue where I am. And on the medium to long term, it was like, well, I'm going to obviously get a higher salary and I'm going to earn more money and we're going to have more income coming in. Therefore, I'll be able to start eating into that mortgage and I'll probably even get a better deal later on. That's how I looked at it. And that's potentially how some people could look at it right now. But your own personal circumstances have to apply. That's why I keep saying to you, speak to a mortgage broker. And if you need one, we'll point in the right direction. And they go on to say, Zoopla actually say that quite rightly. They've just exactly what I said. However, these aren't options for everyone. The longer rates stay above 5%, the greater impact on the number of buyers in the market, which impacts sales volumes and price inflation. Sales volumes are obviously tantamount and the most important thing. Surge in supply, they go on to say surge in supply could drive larger price falls, which means if there's more supply comes onto the market, people could be more realistic because there's more choice for buyers. Therefore, it turns to a buyer's market. Therefore, there's better negotiation for buyers. Therefore, prices might have to realign a bit more and come into a more realistic number, possibly below home report value for the Scotland area, especially the English area. You know, they're away in the stars and they'll have to come down significantly. But that's no surprise. There is an expectation in the English market in terms of the UK prices that they will obviously be a lot less than what they're asking for in the first place. That's why people from England actually see a total disparity in Scotland where they go, well, it's offers over. We've never been in a market with offers over. But that's typically how the Scottish market works because we start at the bottom end and work our way up where they start at the top end and work their way down. And we meet in the middle somewhere with both housing markets. But more or less we pay the same prices for the same types of properties in the same sort of areas. So Zoopla going to say, aside from the weaker economic growth, the main downside risk to house prices is a surge in the supply of homes for sale. That's the main risk, and some signs that the supply is starting to grow at above average rate, with 18% more homes listed for sale in the last 4 weeks than the 5-year average. This is people now becoming realistic about the 1.3 million fixed rate mortgage homeowners in the UK now coming out of their fixed rate deals by the end of the year. Therefore, they're having to think, okay, am I really going to be able to afford that? If you're coming at the end of the year, then talk to your bank now. Remember, they can't do anything. They can only advise you on what to do. They can't then turn around and go, well, we don't think you're going to afford it by the end of the year, so we've got a problem here. They have to wait till the end of the year, and then they have to be agreeable, and then have to help you as much as possible. This is all set in stone, by the way, from the last credit crunch. We just don't remember it. We used to do that. So there is negotiation with the banks. You just don't know it yet. So they go on to say the number of homes for sale is back to pre-pandemic levels. Further expansion in homes for sale, either voluntarily or partially forced through changes in circumstances, there you go, would boost supply. This would increase choice and create further room for negotiation on price. The Bank of England data shows mortgage arrears rates have increased off a low base in the first quarter of 2023. Anecdotal evidence from the industry insiders suggests that most borrowers are paying an extra monthly mortgage cost at refinancing rather than extending mortgage terms. So in other words, they're paying the extra and refinancing. In other words, they're going at a new mortgage term. Rather than actually doing what I said, is pushing the mortgage terms out a wee bit more, therefore bringing down your monthly payment to a more affordable cash flow basis every month. In other words, you're getting to the point where you've got more cash at the end of the month, not more month at the end of the money. So 15% of mortgages will refinance this year, they're going on to say. These extra measures to boost the forbearance of mortgagees will limit forced sales in the near term. So they'll limit the forced sales. In other words, that's repossessions and people saying that, well, you can't afford it, you need to sell your house. So that'll be very, very limited for that reason. New sellers, though, must be realistic if they want to move. The desire to move home continues to be driven by a range of demographic and lifestyle factors. It's certainly not all about aspiration for a bigger or better property. I'm visiting people now who just want to be mortgage free. They no longer want to hold that mortgage because mortgage rates are going up. So they're going from a bigger house to look for a more affordable, smaller house. Zoopla goes on and they say, we believe that the rising living and housing costs will continue to keep owners reviewing their housing needs, with moving the best option for some out of choice or necessity. Whatever the motivations are, the key message for anyone serious about moving in 2023 is the need to be realistic on pricing, seeking the views and expertise of local agents as they plan their move. This is so important, to get the advice of a local estate agent first. Now, we are local. So in Fife, we are local anyway. So it's important to get that advice from that local estate agent first, because remember, you don't know what you don't know. We know what you don't know as estate agents. We know how to, for example, I've just told you about how you could push your mortgage out to a higher term and how you could put you in touch with the right people in order to do that and speak to the right parties in order to get the right information. So you don't know that because you're not expertise in that, and that's our job to be that. So it's our job to advise you that, and that's where our expertise and added value comes in. So the outlook, Zoopla's final outlook on this then. Let's look at this and finish off here. They think the resilience of the housing market and home buyers is set to be tested once again as mortgage rates increase over 5%. Firmer pricing this spring shows 4 to 5% mortgage rates are manageable, but the longer the rates stay over 5 and the closer to 6, the increased hit to buying power will result in lower prices and sales volumes overall. The transition to higher borrowing costs will take time to feed through. Lower sales on track to be 20% down on last year has been the main initial impact. Now, if lower sales are on track to be 20% in last year, it doesn't need to bother you in terms of the consumer or the seller or the buyer. The person that the lower sales and transactions hit is estate agents, is solicitors, is mortgage brokers, is the contractors. Because if there's lower sales, this is what I talked about the health of the housing market, is all about the stability in the transactional numbers, which is the sales, because then it keeps everybody in a job. It's a huge economy and a huge business. If sales drop by 20%, for example, I'll get my calculator. If sales drop by 20%, say 6,500, and Fife, just take Fife for example, 6,500, and we take 20% of that, that's 1,300 households less selling every single year. Now, if every single household spends, well, we'll just say £10,000 on improvements. Some will spend more, some will spend less, some won't spend anything at all, so that's why I say 10. Multiply it by 10,000, and that comes to £13 million. So that means if sales drop, transactional sales numbers drop in Fife by 20%, that's £13 million more money less to go to contractors, to keep people in jobs, to buy from warehouses, B&Q, places like that. So it affects overall the 13 million just in the 5 housing market if it drops by 20%. That's why transactional numbers is more important than actual house prices overall. That's the most important thing. If transactional numbers stay healthy and they stay consistent every month, nothing to worry about. Everything else is short term. So then what Zoopla go on to say, and this is key important as well, there's a large equity buffer to absorb house price falls, making the risk of negative equity much smaller than previous downturns. Remember, I talked about the 30% increase in the last 3 years in house prices. Even if house prices drop at the credit crunch level, which is 20%, everybody's still 10% up on 3 years ago, if that's the case. Banks are still fine because liquidity is still there then, because there's huge equity gains in property. So banks will still be okay as well. So therefore, their liquidity will be fine. They'll be able to still afford to give mortgages. So that's why it's so healthy, this market right now. And it's a different market from the 2008 and 2009. The bigger challenge for the housing activity is the affordability of the monthly payments for buyers. That's the most important thing. And those remortgaging set against a wider increase of other cost of living, the cost of living. See, I don't prescribe to this. What it actually costs you to live. Well, no, it doesn't cost you to live. We should actually come up with some sort of term for this, because it doesn't cost you to live. You live every single day. The understanding is it costs money to run things. In other words, to get your power, to feed yourself, to pay your mortgage. That's a different scenario. It doesn't cost you to live, if that makes sense. But we all know what the cost of living is and what it means. So we could stick to that, I suppose, as a generic term. But just be aware of that, what you're saying to yourself when you say it. They go on to say household budgets have been squeezed and we look set for a prolonged period of low nominal house price growth, which is fine, stabilisation, which will result in a steady realignment of house prices and household incomes over the next 3 to 5 years. So this is going to be over the next 3 to 5 years. This is what I talk about. That's short term, 3 to 5 years. When you go to 5 years to 12 years, that's medium term. When you go to 12 years to 20 years, that's long term. So they go on to say the outlook and that, and that's fine. And we could finish off up there. My prediction, though, is over the next 20 years, and you'll not see this coming, I think house prices will double again over the next 20 years. And there's a number of factors influencing that. And I will talk about that in another show, but this is not for this show right now. And people will go, you're kidding. How is that entirely possible? And I'll tell you on the next show. Until next time, guys, I'm Jim Parker for Five Properties TV. Tag someone in this post. It has got a house. It has got a mortgage. It's potentially feeling the pinch, because the information that's right in here will help them immensely in working out whether they should be selling or whether they should be going back to their bank and renegotiating with them again and getting a better deal to keep them in their existing home. Okay, until next time, guys, I'm Jim Parker for Five Properties TV.